evening. What do you want to do tonight?
Same thing we do every night, Pinky. Try to take over the world.
Because I found that my colleagues who were getting ready to graduate were competing with 200 people for a $10,000 a year teaching job.
I mean, 200 people with PhDs.
We're competing for one $10,000 a year teaching job.
10,000?
Yeah.
When was this?
This was 1975.
Not that long ago.
And
has it gotten much better?
Yeah, it's probably 30,000 now. So that really wasn't where I wanted to go. And I had a couple of episodes where I thought, well, maybe playing the markets is a way to go. And I'd lose my shirt. I mean, the first time I had about 20,000 that accumulated, and that all disappeared. And then I found you didn't have to stop at zero. You could go in the hole in another episode. And it seemed like 90% of the trades I made were wrong. And I was smart enough, at least after the fact, to look at it and say, if 90% of the trades are wrong, it's probably me, and I better find out what it is that I can do about it. So my career began as a process of figuring out what I could do about it. And instead, I found that my best trades are putting money with the traders I've developed.
So you train your own people that trade your money now?
Absolutely.
So, Ben, would you agree with me that the science and the art of trading is an important skill that an individual should have if they're going to go into the field of investing in business?
Absolutely.
So let me ask you this. How would you define trading personally? I mean, what is it? People have pictures of, we saw that movie called, was it Trading Places or something with
Eddie Murphy and Dan Aykroyd.
Dan Aykroyd, right. It's about how they cornered, was it orange juice in the commodities market and all that?
Right.
So many people have seen that movie or movies like that. Now, in your opinion, is that trading?
No. It has nothing to do with trading. It's just entertainment.
It's Hollywood.
Right.
But people have that perception, is that correct?
And trading's nothing like that. It's simply the art of going with the flow of the markets. Buying when it goes up, selling when it goes down, and making sure you don't lose very much money in the process.
So when I attended your workshop in North Carolina, it was very eye-opening for me because your word is bias, and bias means an opinion maybe or a point of view or prejudice or a way of thinking. I was very surprised in attending your seminar on peak performance trading, and most of them guys in there were either individuals or they work for large banks or companies that handle large sums of money internationally. I was surprised that you told people that traders don't forecast. In other words, today as the stock market's rallying up and down, everybody's saying, well, is this price going to go up? Is the Dow going to go up? Is the Dow going to come down? Will this stock do better? Will it do worse? A trader doesn't do that. Is that correct?
A professional trader doesn't do that.
So what do you think about people who forecast and say, I think the price will go up?
It has nothing to do with making money. Absolutely nothing. Because you get hung up into the bias of being right about your prediction, and that hampers you from knowing what the market's doing.
So this is very much very big part of your book, the word bias.
Correct.
And I think we need to go into that and because a bias is almost a psychological or personal or emotional or a point of view you take on the market. In other words, if let's say I'm buying for, say, IBM at $150 a share, if I think it's going to go up, that's a bias. Is that what you're saying?
That's correct. That's a bias because you're forecasting as opposed to trading.
And traders don't do that.
No.
So what would a trader do?
A trader would say, IBM's going up. I'm going to buy it. And when it stops going up, according to some criteria that they have, they'd sell it.
So they're not predicting it's going up. What you're saying,
They're
it's
watching
going
it,
up.
and it is going up. So they're buying it
So a trader only buys
when it goes up,
and it sells when it comes.
down.
There's a
And
lot
the
of
reverse is also true.
what's that?
They would want to sell first when it's going down, buy it back later when it starts to go up.
That's not a short though.
That's a short.
That is a short. So a trader fundamentally is not predicting. They're actually operating on the facts.
Correct. In observation.
Okay. That sounds very simple in theory, right?
And it is. Except psychological biases get in the way.
Psychological biases like what?
The need to be right, the need to understand.
Well, can you go into the need to be right really quickly?
You talk about it extensively in your book. You go through 20 years of school knowing that you have to get 70% right to pass and 95% is an A. When as long as you've got profits that are much bigger than losses, you could be right 30% of the time and